Warren Buffett, the greatest investor who ever lived, wrote something remarkable in his instructions for his own family. When he's gone, the money he leaves his wife isn't going into Berkshire Hathaway. It isn't going to a brilliant hedge fund manager or a hand-picked portfolio of stocks. His instruction: put 90% into a simple, boring S&P 500 index fund. The man who spent 70 years beating the market is telling his own family not to try. Today, we're going to explain exactly why, and it might be the most valuable money lesson you ever learn. This is the story of the index fund, the most boring, most mocked, and quietly most revolutionary financial invention of the last 100 years. It's the story of a man who was ridiculed as un-American for creating it, a $1 million bet that humiliated Wall Street's finest, and a mathematical truth so uncomfortable that an entire trillion-dollar industry spends billions in advertising hoping you never fully understand it. By the end of this video, you'll understand it. And you'll understand why the laziest strategy in investing beats almost everyone who tries harder. First, a piece of jargon we need to defuse. What exactly is an index? It's simply a list, a scoreboard of the market. In 1896, Charles Dow created the famous Dow Jones Industrial Average, tracking a dozen industrial giants so newspaper readers could answer one question: did the market go up or down today? In 1957, Standard & Poor's launched the S&P 500, a broader, smarter scoreboard of America's 500 leading companies, weighted by size. For decades, these indexes were just measuring sticks, the thing funds try to beat. Nobody imagined the measuring stick itself would become the best investment ever offered to ordinary people. Let's build from the ground up. When you buy a share of stock, you own a tiny slice of a real company, its profits, its growth, its future. Pick the right company and you can get rich. Apple, Amazon, Nvidia early would have changed your life. Pick wrong, Enron, Blockbuster, Lehman Brothers, we've covered where that leads, and you can lose everything. So the entire game of investing for a century was framed as one question: how do I pick the winners? Armies of analysts, advisors, and fund managers built careers selling their answers. And here's the industry that grew around that promise: actively managed mutual funds. You hand your money to a professional, a smart, credentialed expert with research teams and Bloomberg terminals, and they pick stocks on your behalf, charging a fee for the service, typically around 1% of your money, every single year, plus trading costs. It sounds completely reasonable. Experts should beat amateurs. Professionals should beat the average. For decades, virtually all of America's retirement money flowed through these funds on exactly that assumption. There was just one problem. Someone checked the results. The results are the scandal at the heart of modern finance, and they've been replicated so many times it's no longer controversial, just ignored. Over any long period, the overwhelming majority of professional fund managers fail to beat the simple market average. The standard industry scorecards find that over 15-year stretches, roughly 90% of actively managed U.S. stock funds underperform their benchmark index. 9 out of 10 experts, with all their research and salaries and confidence, lose to a list of stocks nobody is managing at all. Let that sink in before we go further. The academics saw it first. In the 1960s, economist Eugene Fama documented that market prices absorb new information almost instantly, meaning yesterday's news is already in today's price, and consistently outguessing millions of informed traders is close to impossible. In 1974, the legendary economist Paul Samuelson published a direct challenge to the industry, arguing most fund managers should go out of business, and openly begging anyone, to launch a low-cost fund that just tracked the S&P 500. The following year, industry veteran Charles Ellis wrote a famous essay calling professional investing a loser's game, one where trying harder makes results worse. The intellectual dynamite was stacked. It just needed someone reckless enough to light it. Why do the professionals lose? Not because they're stupid. Most are genuinely brilliant. They lose because of structural math, and this is the key insight of the whole story. All investors together, by definition, earn the market's average return before costs. For every trade that beats the market, someone's on the other side losing to it. Professional investing is mostly professionals trading against other professionals, a zero-sum knife fight among equals. Then costs enter. The 1% fees, the trading commissions, the taxes from constant buying and selling. After costs, the average professional must underperform the market. It's not a possibility. It's arithmetic. One man saw this arithmetic clearly and decided to build a product around it, and Wall Street never forgave him. His name was John Bogle, Jack to everyone, a Princeton economics student who wrote his senior thesis on mutual funds in 1951 and spent 20 years inside the industry watching fees devour investors' returns. In 1974, after being fired from his own firm in a merger dispute, he founded a strange new company with a structure nobody had tried. It would be owned by the funds themselves, meaning by the investors. No outside shareholders demanding profit. He called it Vanguard. In 1976, Bogle launched the first index investment trust, the first index fund available to ordinary people. The idea was almost offensively simple. Don't pick stocks at all. Just buy every significant company in America, all 500 in the S&P index, in proportion to their size, and hold them forever. No genius manager, no research department, no trading. Just own American business as a whole and charge nearly nothing for it. The fund aimed to guarantee you the market's return, minus fees so small they barely existed. Wall Street looked at it and burst out laughing. The mockery was vicious and public. Competitors printed posters declaring index funds un-American, literally, asking who would settle for merely average returns. They called it Bogle's Folly. The fund's launch was a disaster. Underwriters hoped to raise $150 million. They raised about $11 million, not even enough to buy all 500 stocks properly. For years, it limped along, ignored and ridiculed. One fund executive sneered that indexing was a formula for mediocrity. What that executive didn't understand was that guaranteed mediocrity at near zero cost mathematically beats expensive attempts at brilliance. Almost every time. Because here's the engine that makes the boring index fund a wealth machine. The tyranny and a magic of compounding costs. It sounds tiny. The active fund charges 1% a year. The index fund charges a few hundredths of a percent. Who cares about 1%? You should. It might be the most expensive single percent in your entire life. Let me show you the math that Wall Street's advertising never shows you, using numbers that could be your own retirement. Take a young worker investing $500 a month for 40 years, with the market returning its rough historical average. In an index fund, charging almost nothing, that steady drip compounds to roughly $1.5 million. The identical investments in the typical active fund, same market, same returns, minus that 1% annual fee, ends up somewhere around $1.1 to $1.2 million. The difference, $300,000 to $400,000, an entire house, years of retirement, vanished. Not lost to a crash, not lost to a scam, quietly transferred, year by year, to the fund company. The fee didn't feel like anything. It cost everything. Now, the honest exception, because it exists and it proves the rule. A secretive firm called Renaissance Technologies ran a fund, Medallion, that beat the market so consistently and violently for decades that it became legend, powered by an army of mathematicians and computing power no ordinary investor could dream of. Here's the punchline. Medallion closed itself to outside money decades ago. The truly market-beating machine doesn't want your dollars. It doesn't need them. The funds aggressively advertising for your money are, almost by definition, the ones without the magic. If someone truly had Medallion's edge, they wouldn't be selling it to you for 1% a year. There's also a tax trick hiding inside the index fund that rarely makes the brochures. Active funds trade constantly, and every profitable sale inside the fund generates capital gains taxes passed straight to you, even if you never sold a share. Index funds barely trade at all. They just hold, so the tax bill stays asleep, compounding for you instead of the government, until the day you choose to sell, ideally decades from now, in retirement. For investors and taxable accounts, this silent tax efficiency can be worth as much as the fee savings. Laziness, it turns out, is also a tax strategy. And that math assumes the expensive manager merely matches the market, which, as we saw, 90% fail to do over the long run. So the realistic comparison is even crueler. You pay premium fees for below-market results. Bogle had a phrase for this that should be carved above every brokerage door. In investing, you get what you don't pay for. Every dollar of cost is subtracted directly from your return, with mathematical certainty, while the brilliance you're paying for is, statistically, a coin flip that lands against you 9 times out of 10. Cost is the only factor you fully control, so control it. For 30 years, the argument raged. Indexing zealots versus stock-picking believers. Then Warren Buffett, the one man with undeniable credentials on the active side, settled it with theater. In 2008, he publicly bet $1 million winnings to charity that a simple S&P 500 index fund would beat any collection of hedge funds, the smartest, highest-fee money managers on earth, over 10 years. A firm called Protégé Partners accepted, selecting 5 elite funds of hedge funds. The financial crisis hit immediately, the worst possible start for the index. Wall Street's finest had their shot at proving expensive expertise wins. The result was a massacre. Over the 10 years, the index fund returned roughly 126%. The hedge fund portfolios returned around 36% on average, some far less. It wasn't close, wasn't debatable, and the timing detail makes it worse. The pros got their crash, their volatility, their supposed edge conditions, and still lost by 90 percentage points. Buffett's postmortem was blunt. Performance comes, performance goes, but fees never falter. The $1 million went to charity. The argument, for anyone honest, went to Bogle. So what exactly are you buying when you buy an index fund? Let's make it concrete. An S&P 500 fund holds shares of the 500 largest American companies. Apple, Microsoft, Amazon, the banks, the railroads, the drug makers, the retailers, weighted by size. One purchase, and you own a slice of essentially the entire engine of American capitalism. When any company innovates, you profit. When one dies, it drops out of the index and is replaced by a rising star. Automatically, no decision required. It is self-cleaning, self-updating ownership of the economy itself. That's the product. The genius is what's missing: managers, activity, and fees. A quick practical decoder, because the industry loves confusing labels. A mutual fund and an ETF, exchange-traded fund, are just 2 wrappers for the same idea. The ETF trades like a stock all day. The mutual fund settles once daily. And for a long-term investor, the difference barely matters. What matters is the words index and expense ratio. Total market funds own thousands of companies instead of 500, fine, nearly identical in practice. International funds add the rest of the world. Target date funds bundle it all and adjust with age. The entire menu you actually need is about 3 funds long. Everything else is marketing. For American viewers, one piece of practical order of operations, because it supercharges everything else. If your employer offers a 401k with matching contributions, that match is an instant, guaranteed 50 to 100% return, the only free money in finance, and it comes before any index fund math. The classic sequence: contribute enough to capture the full match, then fill tax advantage accounts like a Roth IRA with, yes, index funds, then invest beyond that in a regular brokerage account. Same boring funds inside every layer. The wrapper changes the taxes. The strategy never changes at all. Now for the part that separates the people who get rich from the people who merely know the theory: behavior. The index fund solves stock picking, but it cannot solve you. Because the market's historical average, the one that builds all that wealth, includes crashes. It includes 2008, when the index fell by half. It includes March 2020, when it dropped a third in weeks. The average return belongs only to those who stayed. Every investor who panic sold in those moments, planning to return when things felt safe, locked in a loss, and missed the rebound. The index fund is a vehicle. Patience is the fuel. The data on investor behavior is genuinely embarrassing for our species. Studies that compare fund returns to the returns actual investors earn in those same funds consistently find a gap of 1 to 2% a year, money vaporized purely by bad timing. Buying after rallies feels safe, selling after crashes feels scary. There's even a famous industry legend that when one giant brokerage studied its best-performing accounts, they belonged disproportionately to people who had forgotten they had accounts or had died. The story may be apocryphal, but every advisor believes it instantly because it matches everything they see. The less you touch it, the more it grows. Contrast all this with what the modern casino offers. The meme stock manias, the zero-commission trading apps with confetti animations, the options gambling dressed up as investing, All of it is engineered to make you trade more, because your activity is their revenue. During the frenzy of 2021, millions of new investors learned expensive lessons about chasing rockets, while the boring index crowd just kept auto-buying and quietly won the decade. There's nothing wrong with a small play money account for fun, 5%, fenced off. Just never confuse the casino floor with the vault. One is entertainment priced as investing. The other is wealth. Here is a mental reframe that turns crashes from terror into opportunity, at least while you're still saving. If you're 25 or 35 or even 45 and adding money every month, a bear market is literally a sale. The same slices of the same 500 companies, 30 or 40% off. The shares you buy in the gloom of a crash are the ones that do the heaviest lifting decades later. Young investors praying for endless bull markets have it backwards. The fortunes of 2030 and 2040 were bought in the despair of 2008 and 2020. The only investors who should fear crashes are those who need the money soon, which is exactly what bonds are for. And connect this to a story we tell often on this channel: inflation. Cash loses purchasing power by design, a couple percent every year forever. A stock index is the opposite kind of asset. You own the companies that raise the prices. When inflation pushes up the cost of groceries, phones, and insurance, it's flowing through the revenues of the very businesses in your index fund. Over long periods, equities have been one of history's most reliable inflation defenses, not because they're magic, but because ownership beats holding the currency that everyone else is printing. The index fund is, quietly, an inflation escape hatch available to anyone. This is where the strategy called dollar cost averaging becomes your armor. Invest a fixed amount automatically every month in booms, in crashes, especially in crashes forever. Automation removes the two most expensive employees in your financial life: fear and greed. When a market plunges, your same $500 quietly buys more shares at discount prices. When it soars, you're already in. You never make the catastrophic decision because you never make a decision at all. Boring? Completely. And that's precisely the point. In investing, excitement is a cost center. Boredom compounds. And there's a scenario every honest indexer must know about: the lost decade. An investor who bought the S&P 500 at the peak of the dot-com bubble in early 2000 waited roughly 13 years, through 2 crashes, just to get back to even before counting dividends. A decade plus of flat returns is psychologically brutal, and it's the strongest argument for 2 boring safeguards: diversifying beyond one country. International index funds exist for exactly this reason, and holding some bonds as you age, so a bad decade for stocks isn't a bad decade for your life. The index guarantees you the market's fate. Diversification decides how much any single market's fate can hurt you. Let's also flag the common ways people take this beautiful, simple idea and quietly ruin it. Mistake 1. Collecting funds like souvenirs, 10 overlapping ETFs that all secretly hold the same giant companies, adding complexity without diversification. Mistake 2. Thematic temptation, swapping the boring index for whatever sector fund is hot: robotics, cannabis, AI, which is just stock picking wearing an index costume, usually bought after the boom. Mistake 3. Checking the balance daily, which manufactures anxiety and eventually bad decisions. The strategy is 3 funds, automatic contributions, and an annual glance. Every addition beyond that is usually subtraction. Let's be honest about the limits and the criticisms, because indexing is not a religion and this channel doesn't sell fairy tales. Critique 1. Concentration. Today's S&P 500 is heavily weighted toward a handful of giant technology companies. When you buy the index, a big slice rides on just a few names, and if that leadership stumbles, the index feels it. Critique 2. You own the bubbles. An index blindly holds whatever is overpriced right along with the bargains. Indexing guaranteed you full participation in the dot-com mania and the 2008 bank bloat, on the way up and the way down. Critique 3. The philosophical one. If everyone indexed, who would set prices? Markets need active traders hunting mispricings to stay efficient. Indexers are free riding on their work. It's a fair point in theory, and in practice we're nowhere near that world. Trillions still chase active bets daily, and the moment indexing ever truly broke price discovery, the profits for active managers would explode and pull talent right back in. The system self-corrects. For you, the individual, The practical answer stands unchanged. Let others fight over pricing. Collect the average they produce at near zero cost and get on with your life. The fee war Bogle started eventually reached its logical conclusion: zero. Competition from index funds dragged the industry's average cost down relentlessly until major brokerages began offering index funds with expense ratios of literally 0%. Loss leaders to win customers. Unthinkable in the era when 1.5% was standard. Think about what that means. The core wealth-building tool of our civilization now costs nothing to own. A janitor today invests on strictly better terms than a millionaire did in 1980. That, more than any single fortune, is the revolution, the machinery of compounding handed to everyone free. One fair question deserves a straight answer. Does this mean all financial advice is worthless? No, and the distinction matters. What's usually not worth paying for is stock picking, the promise of beating the market. What can be genuinely worth paying for is planning. Taxes, insurance, estate decisions, retirement withdrawal strategy, and, above all, someone who stops you from panic selling in a crash. The key is how you pay. A flat fee or hourly fiduciary advisor, legally bound to your interests, costs hundreds. A 1% of assets advisor costs, as you now know, a fortune in compounding. Buy advice like a service, not like a toll on your wealth. And what happened to Jack Bogle, the mock prophet of all this? He lived to see Bogle's Folly conquer the world. Vanguard grew into a titan managing many trillions of dollars. Index funds went from 11 embarrassing millions to holding more of the U.S. stock market than active funds. The crossover happened, the average won. And because of Vanguard's strange investor-owned structure, Bogle never became a billionaire. He made investors rich instead of himself, dying in 2019 worth a rounding error of what he created. Buffett's tribute said it all. If a statue is ever erected to honor the person who did the most for American investors, the choice should be Jack Bogle. Run the numbers on that legacy, and it becomes one of the greatest wealth transfers in history in the right direction for once. Every 0.1% that fees fell across the industry, forced down by index competition, is billions of dollars a year that stays in teachers' retirements, nurses' 401ks, and ordinary families' futures instead of flowing to Manhattan. Estimates of what Bogle's revolution has saved investors run into the trillions, quietly, compounding, forever. One stubborn man, one boring idea, and more real wealth moved to ordinary people than perhaps any financial invention ever. That's a money story worth knowing. So let's distill the lessons because they extend far beyond funds. Lesson 1. In any game, know whether you're paying for skill or paying for the average dressed up as skill. Most expensive expertise in investing and in life fails to beat a cheap, systematic baseline. Demand proof over long periods after all costs before you pay premium prices. Lesson 2. Small recurring costs are giant costs wearing camouflage. 1% a year sounds like nothing and silently confiscates a third of a lifetime's gains. Audit every percentage that touches your money annually, fees, interest, subscriptions, because compounding works exactly as hard against you as for you. Lesson 3. Automate your discipline, because your future depends on decisions your emotional self shouldn't be trusted to make. The best investors of the past decades weren't geniuses. They were people whose money moved automatically, who couldn't panic because no button was in front of them. Lesson 4. Time the market beats, timing the market. Every study, every era, every crash confirms it. And Lesson 5, Bogle's own. Simplicity is the master of sophistication. The financial industry manufactures complexity because complexity justifies fees. When someone makes your money complicated, they're rarely doing it for your benefit. The winning strategy fits on an index card. That's not a bug. It's the whole point. It even connects to the modern movements you've heard about. The entire financial independence community, people retiring decades early on ordinary salaries, is built almost entirely on this one chassis. Aggressive saving poured into index funds, harvested later under the classic 4% guideline, spending roughly 4% of the portfolio a year, which historically lasts a lifetime. Whether or not extreme early retirement is your goal, the mechanism is universal. Every $100,000 indexed is roughly $4,000 a year of permanent, inflation-fighting income. Your freedom, purchased in monthly installments, at a cost of nearly nothing. And this revolution has gone global. The same logic that conquered America is spreading everywhere. World index funds now let anyone own thousands of companies across dozens of countries in a single purchase, from Tokyo to Frankfurt to Sao Paulo. For pennies of cost, a nurse in Ohio can own a slice of the entire productive planet, something no king, no tycoon, no Rockefeller could have engineered a century ago. It's worth pausing on that. The most powerful wealth-building instrument in history isn't gated behind privilege anymore. It's sitting in every brokerage app, ignored while the world argues about lottery tickets and meme coins. Here's the quiet, almost anticlimactic truth at the end of this story. The path that beats 90% of professionals, that Warren Buffett prescribes for his own family, that turned a mocked $11 million fund into the backbone of the world's retirements, requires no genius, no timing, no hot tips, no watching markets, ever. Buy everything. Pay nothing. Add money every month. Ignore the noise for decades. That's it. That's the secret Wall Street's marketing machine has spent 50 years talking over. The lazy strategy wins not despite being lazy, but because of it. Effort, in this one arena, is usually just expensive noise. If this changed how you think about investing, fees, and who actually wins on Wall Street, then this channel is exactly where you belong. We break down the biggest money machines on the planet, the empires, the scams, the quiet revolutions like Jack Bogle's, and pull out the lessons that protect and grow your own money. Subscribe to Money Stories, ring the bell, and tell me in the comments, are you team index fund, or do you still believe you can beat the market? Make your case. See you in the next one.